The tech-heavy NASDAQ shares off just about 0.7% this morning here in the first couple of minutes of trading following yesterday's rebound that we saw, the rally in some of those Mag 7 names. While the Magnificent Seven's market cap is 4 times the size of the entire Russell 2000's market cap. This is pointed out in a note here this morning from Apollo's Torsten Slok. While Microsoft alone, to put it in perspective for everyone, is the size of the entire Canadian stock market. So AI, it's been driving this bubble that we've seen and some of these larger cap names. The risk that maybe we could see this bubble burst is what is being talked about here, especially on the heels of the pullback ride that we saw to start the year. We're bringing this up because we're about to enter earnings season, and I think a lot is riding on the results that we're getting really across the board, but especially what we are going to get for some of these tech names, because we know that investors want to see the impact, want to see the revenue that's being generated from some of these AI initiatives. And if they don't meet those expectations, if they don't exceed those expectations, we could see some pressure on these names that make up almost 30% of the S&P 500.
Yeah, big show me story energy that ultimately could mean a rug pull in terms of some of the AI sentiment, at least for right now. Of course, this is not knocking any of the benefits, whether that be in productivity, whether that be in some of the margin profiles that many of the tech companies that have been able to build out an AI strategy or even acquire to grow or invest in other companies to grow. We're looking at you, Microsoft. Most notably here, I think it's going to come back to, even in this period, for the companies that aren't immediate beneficiaries in terms of their revenue and even trickling through to bottom line of some of the AI touting that they've been doing. Then what does that next rotational cycle look like for the next big catalyst that they can point to where investors will believe that they're able to see a significant growth story or narrative start to emerge? However, that's still a larger question, I think, in this early throes here of 2024 right now.
Certainly is. All right, well, let's talk a little bit more about the moves that we're seeing this morning and what it means for investors going forward, because big tech taking a bit of a breather, pulling back after yesterday's rally. Investors looking ahead to the inflation print that we'll get on Thursday and also the start of earnings season later in the week. So how should investors play a pullback like what we are seeing today? And for that, we want to bring in Michael Antonelli. He's Baird's managing director and market strategist. Michael, it's great to see you. So I think a lot of investors at home are questioning whether or not this bull market that we've seen, if it's still intact. What do you think?
Great to see you guys. Love this morning brief too. This is a great show. I think it's still intact, and there's a couple reasons why I think that's the case. Number one is the economy remains strong. Let's remember that, you know, the stock market generally tracks the economy. It certainly bounces around on emotion and sentiment in the short run, but in the long run, it does generally track corporate profits in the economy. And I think that continues to remain stable, continues to remain strong. Last year, I was in the no recession camp. I'd like to put that out there, and I'm in the no recession camp this year too. I just don't think the U.S. economy is on the verge of one. A couple different reasons we could dig into that if you wanted to, but we are a lot like you guys looking for narratives early in the year. We're looking for what's going on. What should we be thinking about as the year starts? Should we be buying all-time highs? Should we be taking profits here? And I don't think there's a narrative quite yet that we could grasp onto, but I do believe that the trends that we saw at the end of last year, which was improving earnings, strong household consumer balance sheets, those are all still with us. So I still want to stay in the market. I definitely want to buy in the market.
Well, Michael, first and foremost, 25 fantasy points to you for the morning brief. Positive feedback there. Also, in the no recession mindset, what is the top trade that emerges?
I mean, certainly you could look at just the index in and of itself. You could say, I'm sticking with the 60-40. I'm sticking with the overall indices. That would be a trade that would be, you know, pretty standard fare if you're in the no recession camp. If you're in the no recession camp, I think you're also looking at industrials. I think you're looking at financials, which both have done very well over the past few months. Industrials I'm really interested in industrials. I know, you know, I know communications and tech takes up the lion's share of what we talk about, but if you were to look at the industrial sector, it's been a couple years going nowhere, going sideways, and it just made a new all-time high recently. So I think we need to be picking through the industrial sector, distributors, machinery. If you're in the no recession camp, industrial financials, good spots to start looking.
Michael, why are you in the no recession camp? Because I think a lot of strategists are still bracing themselves, saying that, hey, we could see a recession over the next 12 to 18 months. So what is it that's making you so optimistic?
We could do a whole show on this. In fact, I may need to blog on that after this. So there's 6 things that the NBER looks at, right, to pick a recession. 6 things. Things like, you know, real personal income and real retail sales and real consumer spending. Of the 6, In the past 6 months, 5 of them are still positive and growing. Only 1 is negative. It's industrial production. 6 of them are still growing. Equifax just put out their consumer delinquency data. They look at all consumer delinquency. The delinquency rate's about 1.8%. That's one of the lowest in years. Delinquencies have kind of flattened out here. So consumers are just in a great shape. We keep neglecting the fact that a lot of consumers have 3% mortgages and they have jobs and they're still spending. Do they hate inflation? Yes, 100%. But the things that cause a recession just aren't flashing. I mean, I know the yield curve's inverted and we've talked about that for like 48 months, but the stuff that causes a recession just isn't flashing.
All right, fair enough, Michael. Look, at the end of the day, this is also an election year, and you had particularly put some notes together on this as well. The evidence of history, and does history, of course, past performance does not equal future results, but does history, you believe, repeat itself in this general election year?
I'm going to spend my entire year talking about elections in the markets. I know I will. If you'd like to invite me on, I'm happy to do that with you guys. I like looking at the evidence of history, which means I like looking at what happened in the past. What were the certainly they don't repeat. Certainly that again that notion of past results not repeating, that's 100% true. But there are some things that I think you want to look at, like in an election year. Okay, when an incumbent stands for re-election, the stock market has not been negative going back to World War II. The election year, so that would be this year. Why is that? Well, more than likely, the incumbent is trying to continue the strength of the economy, trying to continue his policies. If you were to look at, has there been a recession within 2 years of an election? The incumbent, if there was a recession, lost. If there was not a recession, the incumbent won. Why is that? The obvious reason, right? Economic pain causes people to want to make change. So those are the evidence-based things I'm looking at to try to remind people, and you guys help me out with this year. 2024 is a chance to make a real mistake as an investor, a real mistake, by letting politics impact you. The stock market, I've looked at all the data, does not root for certain outcomes. Okay, it does not. So use this year not to make a mistake due to politics. I'm begging everybody listening and watching.